Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 14 weeks ago I highlighted a bright pink July 24 to date rectangle pattern. It's currently 9.55 to 10.97. This pattern is still operational even now. The top side for this pattern is also capped by the nearby 50% Fibonacci line of the May to August 24 move at 10.98 and the 61.8% absolute Fibonacci line at 11.06. Nearer term, the market has over late April and early May had tried to stabilise over the November 2020 low at 10.45 and looked for a while like it might try higher, but last week prices pushed back down below it, pressing down through the mauve medium moving average, currently 10.44, and the green short medium moving average, currently that's at 10.42, as well as the congestion at 10.33. But, as I said last week, and I quote, but further down is the slowly rising long moving average, now highlighted in gold and currently at 10.26, which I suspect may be the next level to be tested, end of quote. This in turn proved to be the case, and after only 2 sessions of testing, prices have turned back upwards. Yet now on the rise we have seen the green short medium moving average and mauve medium moving average, until today really, and even the November 2020 low capping the rise yesterday. Above this low we have a lot of congestion now, dating from early April, that stretches from about 9.90 up to about 10.70. Whilst below the gold long moving average you only have congestion down for the most part between the mid-October 24 to mid-January 25 area, all in the 9.90 zone. Now, one further feature. Last week we breached and broke down through the lower tone of the late December 24 to early April 25 bullish Andrews pitchfork, which in the past seemed good at showing the bullish angle of attack. However, this was no longer the case, and I've today retired this pattern. Instead, finessed this into what is now the dark blue bullish shift pitchfork for the same move. On this new pattern, we are right now in between the lower time below, currently at 10.06, and the middle time above, currently 10.70. Now, one other feature to be aware of, and it's something I've mentioned before, is that we had a monthly key reversal up for April. And whilst normally I would say that all things should be seen in the shadow of this monthly pattern, including any attempts lower, this far distance from it, and I suspect we may be seeing its force waning, but we'll see, Steve. We'll still see. Chicago soybean meal. 9 weeks ago, I linked the recent highs into a bright red downtrend, currently at 2.97 even. This also tied in nicely, for a while, with the descending gold long moving average, currently at 305.15. That was just above it, shadowing the downtrend a little higher up, but is now flatlining. Plus the green short medium moving average, currently at 298.70, that was and still is mixing it with prices. As well as is in the most recent instant, the mauve medium moving average, currently 302.5, which earlier had failed to provide much resistance above, now has energized itself as a resistance, and quite a good one, over the last 4 weeks. However, 2 weeks ago we had a clear close over the bright red downtrend, and last week another, and this week the market's been trying to stabilize over this breached, possibly broken downtrend. It really relied on the overhead mauve medium moving average in recent days to cap the market's rise. This breach on the upside, in my opinion, is yet to be called a break higher, as I am not impressed with the show of any significant bullish incentive in trying to move higher right now. Thus, all this impinges on my thoughts from 10 weeks ago as to whether the whole action this year has developed into a type of descending triangle pattern, possibly even a descending wedge pattern, with the bright red downtrend topside being the upper trend line and the 290 even zone below as the base for the descending triangle, and the earlier January to date purple lower trend line, currently at 285.60, being the lower trend line for the descending wedge pattern. For the future, I think a lot will depend on any move down below 290 even, to see if it will be a descending triangle or descending wedge pattern, or on any true break above the seemingly resistant overhead mauve medium moving average, and ideally over the flatlining to whatever this is, gold long moving average is just above that, for any significant move higher. My major concern is that this is the same as it has been now for 10 weeks here, and that is, as I warned back then and since, and I quote, possible false breaks here out of this proposed descending triangle pattern, end of quote. Now, I had previously left out there open and still live some targets on the downside for the earlier December 24 to early February ascending triangle, and the head and shoulders top for the same move. Primary targets for both of these were reached, but it's still left open and live the ascending pattern. Secondary hardest reach targets in the 265.60 zone, plus an interim target in the 285.30 zone. And for the head and shoulders top, secondary target hardest reach, secondary target down at 280.10. These secondary and interim targets below had been much harder to reach, and I was thinking about retiring them. Indeed, I have decided after today I will retire them. I should also point out that we are today once again just about within the previously highlighted 282 even to 300. Just about, I suppose, really. Congestion dating from between April to August 2020 and reprised back in August and November to December last year. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. As said, and I am afraid I have to repeat something I've highlighted now for 104 weeks, yes, a full 2 years, and I quote, "I now only need to remind you once again of my words when I pointed out the Chicago soybean meal is about to have that rarest of patterns, an annual key reversal down." This duty came about at the end of 2023, and we have been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, "There is only one thing you take away from my musings, let it have been those words." End of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market. Chicago soybean oil. The main pattern here, despite a breach on the upside 2 weeks ago, is still the bright red shallow bullish shift pitchfork for the mid-September to late December 24 move. Prices this week are just above the middle time below, which is currently at 46. I'll have to look at that. At one up, it will be 46.38. And right now, interestingly, sitting on the flatlining mauve medium moving average, currently at 46.55. However, a new pattern emerged over the last month or so. One that I warned about may kick off last week. It is the dark blue ascending wedge pattern, and that's currently 48.51 to 54.48. This had the requisite number of touches on each side, and late last week had a brilliant breach and break lower, dropping down through the significant 38.2% Fibonacci line of the March 20 to April 22 move at 48.95. The green short medium moving average currently 47.78. And this week, down through the, interestingly not yet closing, though interesting not closing yet below it, the flatlining mauve medium moving average and bright red middle time. I said last week, and I quote, it's quite a long one, this one, "Clear consecutive closes below this dark blue lower trend line, I would feel obliged to lay out potentials and even possible targets below for this pattern, something I'm not confident in doing just yet as I fear a possible false break lower." I can only emphasize something I've said only 2 weeks ago, so that's now 3 weeks ago. And that was, and I quote, "It wouldn't surprise me to see some sell stops situated at a short distance below this 38.2% Fibonacci line," end of quote. Well, I think today we have seen those sell stops being triggered once again, and that's the end of the final quote. Well, I now feel obliged to lay out some targets below for this pattern. Arguably, the market has already reached a pretty easy primary target down at 46.03, but we still have a secondary, harder to achieve target X, which is down at 45.03 at the 2014 high below, and a tertiary, much harder to achieve target X1 down at 43.74 at where the 50% absolute Fibonacci line resides. These are quite big targets to achieve on the downside, and we shall see how these develop.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.